Hello and welcome back to the Property Trio, the podcast for the sophisticated property buyer. And it's Market Update today. I'm joined with Dave Johnston and Cate Bakos. Hello.
Hello.
Hey guys, how you going?
It's post-budget, it's post-RBA announcement. The good news is they're sitting still, but the governor is saying it's quite possible we might get another one, which is a very interesting comment. And there's a whole cottage industry of people who pick up the little nuances and semantics in those speeches, so they'll be very, very busy today. But we've now got a post-budget analysis of what's happening to house prices. And Cate, well, it's a bit sad depending on what team you're on.
Well, I think it's tough across the board, and the anomaly is Darwin, but we've talked about Darwin extensively, and it's a very, very small market comparatively speaking. I mean, it's only a little bit bigger than Ballarat, and Darwin did 0.8 for the month, which is miraculous considering what everything else did. The only two others that were in positive territory were Perth and Hobart. And the rest have all exhibited downturns, some of them for the first month in many years. So we're seeing, the effect of increased interest rates and the budget announcement rolling through nationally now. And when we look at combined capitals at minus 0.9 for the month and combined regionals for -2 for the month, our national figure of minus 0.7 is no surprise. And what we all know, and we talk about this a lot, is the lag effect. So I am very firmly believing that we're seeing the early impacts in this data that just broke a week and a half ago.
And Dave, the governor said herself that take this all with a little bit of a grain of salt, because we're talking still 5% annual growth, and I think up about 50% since the start of the pandemic. So we're not really talking about a crash, are we?
No, I mean, how quickly does the media turn where, headlines of a crash and the actual, the numbers that CoreLogic and PropTrack, which is from REA, show a modest declines. Now, I think we know that the actual declines on the ground are much greater. And that's the reality and what we've got to keep in mind. And so something that was quite interesting this month was CoreLogic actually made revisions to some of their declines for the previous months. So I'm not sure if either of you caught that, but
yes.
So for example, so they actually said during periods of rapid market transition, the home value index can experience larger revisions, with July data revealing steeper value declines across May and June than initially reported. Recent revisions reflect how quickly conditions are changing across individual markets. Perth in particular has seen significant shifts, with June growth revised 120 basis points lower in our latest update. So that's material, and like we've spoken about recently, we think on the ground, the actual asking prices in many places are 5-10% lower already. It just takes longer to come through in the data, and CoreLogic have actually acknowledged that themselves when they don't explain how they get those numbers wrong, and then what they find later on that causes them to update it, and maybe I don't know, I won't guess how that comes about, but obviously it is a way of them acknowledging that, and they state that steeper value declines make it harder for them to keep up with the falls.
It doesn't, that doesn't explain away the error to me, right? Because it's like it's a snapshot of time and they report on it. Whether it goes up or down faster or slower shouldn't actually change that snapshot of time. I guess I don't understand their methodology, but that's a huge revision.
Yeah, it is.
Yeah, it is. It is a large revision, significant. So, So look, I know, and I spoke about this in the market update last month. We've just at times like this, when a market's changing direction at a pretty rapid pace, we need to take the numbers from the indexes with a grain of salt, because they are probably behind what's happening on the ground in real terms. And that's why, again, I spoke about this last month. I like to look at other indices that may be more simple in how they measure things, but it might pick up changes sooner. And the prop track growth for 2 months in a row now has every capital city declining. Darwin's growth has only been 0.1% in July, whereas CoreLogic has 0.8. So I imagine on the ground, Darwin's actually already probably in negative territory. And those with the biggest falls in the prop track one are Adelaide at 0.5, Hobart 0.5, Canberra 0.5, Sydney 0.6.
Interesting. I did a little bit of analysis on our own data for Q2, and the average price paid in the Northern Territory was really weirdly high, around $1 million. So it might be that there's a segmentation story there that's propping up Darwin a little bit as well. And that's always the challenge when you get a market that's only got a population of about 150,000. But Cate, you had a point?
We saw the Cotality change, I think, when they changed their business name from CoreLogic actually to play this catch-up game and to show us in the monthly stats how last month's stats have changed and by what magnitude. And I think it's so important to remember this. It's a little bit like the moving target with our auction clearance rates. You see the Saturday rate and the Sunday rate. It has to take into account not only data lag, but the rate at which data comes in. The reported data isn't always there sitting on your desk when you need it. You're compiling these reports, and that's exactly what we're seeing.
So for anyone that hasn't seen the data, if we run down the list, we're talking a national decline of 0.7% in July, with the combined capitals doing most of the work there, just shy of 1% at 0.9%, and the combined regions a little bit more resilient at 0.2%. I think the big movers are Sydney and Melbourne, as we probably expected, though Melbourne, gosh, we're still waiting for that positive number. Cate, there's all sorts of stories about Melbourne actually doing pretty well, so I want to hear your thoughts on that. But across the board, even the markets that are in positive territory, we're talking 0.1 for Perth, 0.1 for Hobart, and 0.8 for Darwin. And the quarterly stories for the nation are negative 1.9%. So she'd be down. Yeah, so I want to hear your thoughts on Melbourne, because we watched a presentation with Tim Lawless, who said that the differential between Sydney and Melbourne has never been broader in their kind of recorded history, at about a 50 to 55% differential. It sort of begs the question, should Melbourne be more resilient because it's already low compared to a place like Sydney or Brisbane even?
Yeah, good question. So if we take that snippet of Tim Lawless's presentation and that thought bubble, that is mean reversion. But he also talked about a couple of other driving forces, one of which was the increased gross rental yield, which, we've watched it climb and climb now for all dwellings. It's hit 4%, which I haven't seen in my professional lifetime. We've always been around 3 or early 3s. The other reason, we do have a lot of new arrivals coming into Melbourne. So, skilled migrants, people with money, putting a pressure on housing. The other encouraging thing that I note about Melbourne is over the last 2 weeks, our city has had the highest auction clearance rates, which doesn't say everything, because not every capital city is dominated by auctions. In fact, really, it's Sydney that puts on auctions to the same magnitude that we do, and Sydney's really taken a hit. I think there's a lot of merit.
But
it could,
we
all
don't
of those
know.
things.
It's too small, but it is a little positive piece of light, isn't it, in the Melbourne property market, the potential for resilience and the first to rebound.
Look, could we haven't gone. You could say that we couldn't move much further, but I look at this last month in the data, it's saying minus 1.2. I didn't think Melbourne could sustain more losses. And anyway, it's begging to differ with me. What I do think we're seeing is other states finding Melbourne more attractive. And I can speak anecdotally about that. I'm working with people from Canberra and people from Sydney and people from Brisbane who are wanting to make the move to Melbourne for affordability reasons. I was even chatting to someone who did the move to Perth a few years ago, and that's the affordability issue is really biting there as well. Rents are very, very high. The cost of living is different. So they might be some of the reasons, but I'm not willing to call it yet. I think I've been Pollyanna on this show about Melbourne many times, and I've been proven wrong, and I'm a little bit gun shy.
Fair enough. Let's actually have a look at rents, because there was another comment from Tim that his expectation is that rents really can't go through the roof, because that's something that commentators will say, okay, well, the investors are exiting the market in droves. He's expecting, maybe investor percentage of loans to go from 40 odd to 20 odd. So, a huge differential there, which sort of begs the question, will that put huge supply constraints on the rental market? I think the answer is yes, but he believes that in terms of household budgets, we can't actually go that much further with rent. Like, tenants are already hitting their head on the ceiling. And I think we saw that borne out. I think that was one of my only successful predictions from 23 or 24, is that rents would still rise, but not as quickly as they did the previous month, because affordability was holding a bit of a floor onto that. What do you think, Dave? I can't believe that they're not going to go up, but I do think that there will be some sort of braking mechanism, because you can't pay 110% of your household income to your rent.
Yeah, look, I think it's proportionate, it's relative. I mean, rents are already rising at a very rapid rate. So again, the last month, July, seasonally adjusted was 0.4%. So that's slightly lower than the previous couple of months, which were around 0.5, 0.6. But it tends to be a quieter month, even though it's seasonally adjusted for people moving in the middle of winter. So I think that still doesn't matter probably how sophisticated you get with your formula. I'm sure it still has some impact. But for the last 12 months, rents have been rising at 5.9%. I mean, that's well above inflation. So even if it just stays around that sort of level for the foreseeable future, I mean, it's still causing a lot of pain to renters, but it is also going to push up yields for investors. If the market's retracting, but your rents are going up by 6%, your yield is going to continue to rise quite rapidly. In terms of the actual specific question, I can see it continuing to increase at this kind of level. I don't think it's off the charts. I understand what you're saying, that, obviously there comes a breaking point. But also, if you are losing the number of investment properties, people have to make different choices. More people, like I did in my final year of uni, I think for a period we had 5 or 6 of us, living in a house in Northcote, so people can make different decisions as well. And also for perspective, 5.9% year on year is an increase in the median rent of $40 per week. So that's a reasonable number for a lot of people. So yeah, look, it probably isn't going to jump to 7 or 8%, but it's already at levels which are very high. And I can see it staying, give or take, around those levels, and certainly above inflation for the foreseeable future.
Dave raises a good point there, Cate, and Tim referenced to that as well. It's something that we suspected would happen on this show as the household formation rate changes and we have more people per dwelling. And census night was last night, so if you didn't fill that out, get onto it at the time of recording anyway. Yeah, that'll be an interesting one to track.
Did you answer the force is your religion? Like 10% of the population does?
Yeah.
I think household formation rate, most definitely, house share as people moving back in, people taking longer to move out. We'll also see tenants displacing. So we're looking at Melbourne data here. We could see tenants moving into regional areas or into, well, dare I say it, other states, but there's pressure on rents across the board. So, yes, I do think that there's capacity for rent still to be strong. I do disagree with Lawless on that. I don't think that you just hit a cap because that's where affordability stops. But I think that we'll see where people are renting change. So obviously investors have been incentivised to purchase in the fringe areas or in higher density inner locations. Well, they will quickly become some of the only options for tenants because it's our established, inner and middle ring areas that are offering houses that we'll see depleting because as those properties sell, they highly likely not to sell to investors.
So crystal ball for the two of you, with gross rental yields lower than they were 10 years ago in a fairly sort of uniform decline apart from a little bit of action during COVID, they've started to uptick. And if we have this continued softening in the housing market and a subtraction of the pool, I do wonder whether investing in property is far less attractive in the established market now because of the negative cash flow week to week. But could we start heading to a point where it overtakes the rental yield from 10 years ago and we start talking about positively geared residential property again in some of our major areas?
With interest rates sitting at 6.5%, it'd need to be an enormous uplift in gross rental yield to overtake that and the land tax and the maintenance and the rates and the insurance and the property management.
Rates to fall as well.
Yeah, right now,
I'm guessing.
We'd need to be getting about 8.5% gross rental yield in this climate for a property to be cash flow neutral for an investor.
Yeah. Look, it might start knocking on the door, depending on obviously the property type and the yield you're getting relative to the price you pay. But I think if we look at that graph or chart where it has combined capitals average across all capitals, obviously, or the 3.6%, that's about its peak, what looks like about in 2018-19. So I think it's going to go past that and keep pushing up towards 4 and beyond, whereas the regionals is 4.2%, whereas regionals have been as high as low 5s. So, that's a real reflection of the story of the price increases in regional centres over a longer period of time. And it's going to be really interesting to track, see what happens with regionals over this period, as well as, the yield increases in the capitals.
Yeah. That's a good point, Dave. And the regions are always a little bit more resilient. But it does sort of seem like yields haven't really done a lot in the environment of accelerating and galloping house prices. But now we have a period of contraction. The yields will be an interesting one to follow. Probably, I think the most interesting story, apart from the price declines for this update, is listings, and it's something that SQM research have flagged as they're seeing, and of course there's markets within markets, but in Sydney and Melbourne, big increases in listings, and the worm has turned a little bit on the listings data. Cate, this one makes a big difference to you because when we talk about housing supply, it's not just building them, it's also what's available for sale. It seems like there's more coming on at a time where it seems like a bad idea to sell. Explain.
Well, at the moment, new listings is under the 5-year average. Total listings is what I'm looking at. It means that total
sort of
listings they are a little bit. Total listings have got closer to the 5-year average, which is higher than past years. But they're still both under. However, the total listings suggest that some of those old listings are still hanging about. More of them are hanging about. And I think we can probably apportion those to the cities that were running really hot, where total listing supply was just soaked up by investors. Think about the conversations we had for Perth and Darwin, for example. I know that Melbourne and Sydney are juggernauts in terms of how much of the data they represent, but I think those cities that were running really hot, take away Melbourne and Sydney, that's still a really big number. And I think we're looking at a lot of old listings now that are sitting around and accumulating now that investors are out of the mix.
Well, yeah, look, I mean, I've got some of the commentary from Cotality, which is a bit more recent for the 3rd of August, and they've observed a deterioration in the flow of new listings. So people are starting to hold off selling, particularly in Melbourne and Sydney. This is led by Sydney because of the weak market. We are seeing total listings continue to increase because the absorption rate, the rate of people buying property is falling. So that means the total listings properties are staying on the market for longer, but we are starting to see a response with less people putting their properties up for sale. And that's been led by Sydney, and it's starting to happen in Melbourne as well.
And the little anomaly here, actually, there's two anomalies, but the big one is Hobart, and the next one's regional New South Wales. Both of these data segments are showing that new listings and total listings are negative, which explains a little bit about Hobart's resilience, because it is such a small city. We often see data blips, and it's very hard to draw a trend line with Hobart because things can change very, very quickly. But with really low stock supply, and I'm talking for total listings, it's down a quarter on last year, so 24.4%. I think that's telling, and I do wonder what is fueling that. Why are people sitting tight and not listing in Hobart?
Yeah. Well, it makes sense, I suppose, that people aren't wanting to transact. Like even owner-occupiers and first home buyers post-budget are a bit nervous about prices, and if you don't have to sell, it's maybe not the best time to do it. But your point about listings is very interesting. There's two real ways to look at it. What's coming on as new and what's staying on, and that number is what we're seeing increase. So it's not a very common thing to describe in Australia, but in other parts of the world they talk about inventory levels, which is maybe a little bit more of an interesting way to look at it, which is kind of months of supply of listings and how long it would take that to disappear. And that's something that I think Kent Lardner really championed in Australia, as entering that into the conversation. He's someone that I sort of do some research reports with, and we unpack a lot of that data. So maybe that's a new way to be talking about it at the moment.
Yeah, and I think people
inventory
can get lost in new listings v total listings v inventory probably delineates more clearly with the language you use versus new listings. And those bar charts, they're July 12. So I think, with that, particularly the new listings numbers were, we've seen a further retraction with Melbourne in particular, and some of the other cities there as well.
Yeah, and Melbourne's got a little bit of an ugly note here with old listings in the SQM data. We can see that Melbourne has the highest proportion of increased old listings, which means that buyers are being really fussy, and we absolutely know that.
Yeah. The old listings one, I know, like, I get excited by it, and then normally, Cate, you're the fun police, and you sort of say, like, oh, well, the sample size is too small for it to be meaningful. But if we completely ignore you, which I'm sure I'll get hate mail for saying, it is really interesting to see places like Darwin that has been really resilient, and Perth that's been really resilient, as firmly into negative territory. Like with Darwin, negative 46.3% of old listings. That kind of says there's a heat, there's a demand. It's the ugly duckling style properties that are still going. So, gosh, I mean, I wish there was a way that we could independently verify and say, look, this is actually a real trend, because it's a nervous little data point. It's not too predictable, and you can't read too much for it, but it can certainly send some price signals. And Dave and I had a little bit of a side project where we were trying to pick the bottom of Hobart for a couple of months, and I think we did fairly well. And that was one of the ones that I was looking at as a bit of a leading indicator.
Yeah.
Well, I think it is a leading indicator. You're just looking for the trend. Because if it happens for enough months and not many people are putting their properties on the market, it's going to make a change to the pricing outcomes. And total listings if they're building up or getting, like, I think, let's watch Darwin. I reckon I would predict that if it was old listings was minus 46%, I reckon that number's going to start coming down towards zero over the back half of this year.
I don't think
one thing, Cate, which I know that you'll be keen to sink your teeth into, is the consumer sentiment, which sadly is only a couple of days away, but we don't want to hold off the market update, indefinitely. But what are your predictions for that?
It's going to be tough, really tough. We've had a little bit of a reprieve, and it's probably a good segue for us to chat about Governor Bullock's speech yesterday. I know this will date our recording, but they used the word jawboning, and it was a good one because she was very clear in pointing out that they did consider a rate rise. And I think that's about keeping everyone prepared and also telling us to continue being mindful of what we're spending and inflation. And, does it affect people's willingness to spend? Yeah, when you've got your governor saying, your Reserve Board governor saying that rates could have gone up and it was a close call, people will be very, very frightened, and they do tend to batten down the hatches. But we're certainly not out of dangerous territory, and with pressure on inflation from everything that's happening globally, and we're talking about house prices, and we've got the shadow housing minister now talking about changing building codes in the national paper. We've got a lot of pressure on inflation, and that is the key concern. It's just not coming down. So I think consumer sentiment will echo that. I think we can anticipate seeing people not buying toys, and we can anticipate people being nervous about family finances. That's my prediction.
That'll be a good one to watch. Dave, I want to ask you about rate predictions. Obviously, interest rate is the most important thing to get when you're getting a new loan. That's rage baiting, Dave. We've done about 1,000 episodes about why the interest rate is not most important. Just making sure you're paying attention, Dave. The 3-year government bonds kind of point to the fact that the markets are predicting that interest rates will stay high, or maybe we even see a bit of an increase. If we look at the ASX rate tracker for September, we're talking about an 84% hold, 16% of a hike and 0% of a cut. But you go forward to the November 3rd meeting and the futures are basically 50-50 on a hike versus a hold. So that is interesting. There is still concern about the stickiness of inflation, and the governor has said, like, paraphrasing, we don't really care about the housing market. We will do what we do. And if it's a rate rise in a declining housing market, so be it.
Yeah, I think you've got competing forces. You've got a property market that's flattening out, which means the wealth effect will cause people to spend less money, which will be deflationary. You've had 3 recent rate rises, and the RBA governor and people suggest that rate changes take a year to flow through to the economy. So you've got these factors that should be deflationary, but we've got a whole bunch of external factors that are inflationary, like what's happening in Iran, the oil crisis, and also our really weak productivity, which she noted and said that's something we can't impact. And if we don't lift productivity, it's very hard to bring down inflation. It makes it significantly harder, or close to impossible. So they're the 2 competing forces. It's why there's a lot of divergent views about whether the next move is up or down. I note, like, the 4 big bank economists have said they think the next move will be down, and that's like towards the back end of next year. So it's a long way into the future. Certainly, I've talked about, I think, the flow-on effects of these tax changes, what's happening in the property market, how it's going to impact a bunch of other industries. is going to be very deflationary, but the productivity and these external and overseas factors are going to make it hard to bring down inflation. So it's going to be interesting to watch. I think it's very difficult to call which one's going to overpower the other in this arm wrestle.
It's the threat of stagflation is huge.
What are your thoughts, Mike?
Yeah, look, I think it is a little bit of a concern. The RBA have definitely flagged that it takes some time for the changes that have already been made to wash their way through the economy. And, it's a little bit like trying to catch a falling knife right now. Things are changing fairly rapidly. I think the jobs market is in flux. We've got, obviously, the changes from the budget. The RBA have said that the price declines have kind of outperformed their predictions. So it's a hard one to navigate. But I keep coming back to the point that Governor Bullock talks all the time about the dangers of inflation and how it disproportionately impacts the poor more than the rich, right? Because it's a tax that disproportionately they will bear. It's not a tax, but it's a cost. It's an impost, right? So that I think is very psychologically important to her. So I think that says to me that she won't be afraid to move, and she's not interested in being popular. She's interested in protecting people, which I think is admirable and kind of what you want from a governor.
Yeah, that's interesting element to her jawboning and making it pretty clear that if she feels like she needs to increase rates, she will, even if it is unpopular. But the big concern for me is productivity, and I reckon I've been banging on about that to some degree for a few years now. And there's some saying like that the economists have that productivity isn't everything when it comes to increasing our living standards, but it's almost everything. And so that is really where we need our governments making policy changes to really support driving productivity in our country, because ultimately that's what makes our dollars go further. And at the moment, everyone can feel that our dollar doesn't buy us as much as we used to, and that is what happens disproportionately when there is high inflation and weak productivity, and that actually, as we've spoken about, leads to disinflation. So productivity is my biggest concern for the country, really.
And it's interesting to observe that people say, well, like productivity, what does that mean? We've got to output more things per labour hour. That sounds like a private business thing, but there are huge things that the government can do to influence productivity. You take one of the worst industries for productivity in Australia, the construction industry, which has been performing at... Yeah. Like I could say, like the guy's having a cigarette and a coffee, Dave. You need to go out and yell at him. And that is probably doing, I think, around about a quarter of the all industries are sort of average of productivity. And things like investing in modular technologies, supporting the banks to fund, precast stuff and all sorts of different innovative construction techniques, the labour and the union influence on productivity. All of these things are actually levers that the government can pull, the planning delays and the construction codes, all those sorts of things. They really do need to get their act together and try and help out on that productivity stuff, especially the construction sector.
Well, I mean, I've just Googled a quote because I read it not too long ago, but the construction industry is I probably shouldn't say this too loud because I got builders around me, but the construction industry, because it's had so much red tape and, government intervention and all the things you were just mentioned, we've mentioned in previous podcasts around it, you know, it has been the worst performed industry by a significant margin in terms of productivity and the time it takes us to build, you know, whether it's houses or commercial properties or whatever it might be. You know, it's been declining for 3 decades. So that's now, there's an estimation that it's cost the economy 62 billion annually. So productivity from 1994 to 2024 in Australia rose just 17% for construction compared to 64% across the broader market sector. So, you know, that is it's been a significant drag on our country.
Just at a time when we actually desperately need more homes, and the government is trying to push investors at least into the new build stuff. But in a declining market, the new builds don't stack up as well, especially when construction costs are continuing to grow. We saw in the June quarter quite an increase in construction cost after a period of consolidation. But I wanted to just maybe finish up, Dave, with a couple of the key takeaways from the RBA's meeting minutes, and of course at 3:30 there was a conference as well. Obviously, we've touched on some of that, where Governor Bullock has said that another rate hike is quite possible, and that housing is not going to save borrowers from higher rates. She's not going to be softer on rates because the housing market is declining. They've said that investor borrowing has fallen sharply. I haven't seen the investor lending data, but they've obviously got some industry sort of insights there. The houses are weakening faster than they expected. Construction costs are still rising strongly. New dwelling construction prices are about 5.3% up annually, but buyer demand and development feasibility is weakening, which is a problem as well. They're actually expecting dwelling investment to contract in 27, 28, raising the risk of weaker construction today as a supply problem for later, which is a huge one. And the other thing that that popped up was data centres. So business investment has actually had an uptick, but data centres are becoming a little bit like the government infrastructure pipeline, which was massive, and it's taking some time to come off, but the peak is sort of foreseeable in 27. But data centres are now pulling trades away from building new homes. So we've replaced the government demand with private data center demand.
Yeah, well, the skills shortage at the end of the day, isn't it? We tend not to bring in to Australia tradies because the unions have so much pull in that space, and so the government's been putting so much money into infrastructure, which takes away from building houses, and now data centers are taking away construction workers from building more housing, and that this problem isn't going away in the short term, which is also partially what'll help put a floor underneath property prices as well at some point, with what's happening now with less investment. But there's no doubt, the banks have been reporting, major aggregators significant lower loan applications. So I think falls of like 10%, 15%, some as high as 20% in terms of the numbers. But there have been some come out, I think, just in the last 2 to 3 weeks, and have said they've started to hit a floor in terms of those lodgement numbers falling, like they've hit a baseline at least, but that is after they've dropped significantly. So, we know people certainly pulled back from buying property initially after the budget, but that might be starting to level out now, and people looking for opportunity.
Well, as always, we'll be here to guide you, dear listener, through what's happening, and there's going to be a lot to talk about, some rocky times ahead. Cate has had to buzz off to an appointment, so it's over to you, Dave. If there's anything else you want to share for market update before we close.
No, I think that's it for me for this month. What I would like to see is all the data providers to get their data out faster at the end of a month, so
Be nice.
we don't have to wait 2 or 3 weeks to get some of the data and the consumer sentiment insights and the listings. And, inflation data can be months behind. But, that's probably my parting note for today.
Surely they know we've got a podcast to try and put together, Dave, and then they should be working overtime going, the guys are going to need this data. But for anyone that wants to know, why are we always so late with the market updates? Is because we're trying to pull in as much data points as we can to tell the stories, because as we all know, the core logic figures are just one data point. They're medians. They're not terribly nuanced or sophisticated, so we try and add all of that flavour, but we love doing that for you guys. Well, that was Market Update, Dave, and we'll see you for the next one.
Yep, look forward to seeing the numbers for August.
Beautiful. Cheers.